So during the period of last financial year, we had continued high inflation and ongoing geopolitical tensions. Argo nevertheless reported a solid profit and maintained its record high annual fully franked dividends to our shareholders. Argo also delivered a full year profit of $253 million for the 2024 financial year, which was down 6.9%. Profit fell overall due to lower dividend income from companies in the investment portfolio, including some of our largest holdings. Most notably, dividends from BHP, Rio Tinto and Woodside Energy were significantly lower, reflecting lower commodity prices. Income generated from option writing and trading activities also declined, whilst income from special dividends increased. In August, the board was pleased to declare a final dividend of 18 cents per share. Together with the interim dividend of 16.5 cents per share, this brought annual fully franked dividends for the financial year to 34.5 cents per share, matching last year's record high. This underscores an important advantage of the listed investment company, or for short LIC structure, which allows us to draw on reserves of retained earnings and franking credits to effectively smooth our dividends over time. In contrast, the cash dividend paid by the constituent companies of the S&P/ASX 200 Accumulation Index fluctuates over time. This volatility was particularly pronounced in the years since the start of the COVID crisis, with the index's cash dividends falling by as much as 45% compared to pre-pandemic levels. Furthermore, since 2019, the index's level of franking has oscillated between 68% and 85%. Throughout the same period, Argo's dividend has remained relatively steady. Importantly, our dividend has been fully franked continuously since 1994. This is particularly valued by those investors seeking a stable and consistent after-tax return. The final dividend also included an LIC capital gain component of 3 cents per share. This is due to the capital gains being crystallised in our portfolio, including due to takeovers. When Argo makes a discounted capital gain, the tax benefit this generates can be passed on to shareholders. In addition to the benefit of franking credits, eligible shareholders can claim a tax deduction in relation to this capital gain. We are one of only a handful of Australian companies able to provide our shareholders with this benefit, which is due to our unique status as a long-term investor, not a trader. Argo's ability to pass on this benefit to shareholders distinguishes us from many other managed funds and LICs. You can find more details on your dividend statement or refer to the dividends section of the Shareholder Centre on our website. Over the 12 months to 30 September 2024, Argo's investment performance, as measured by the net tangible asset or NTA return, after covering all costs and adjusted for company tax we paid, was an increase of 18.9%. This compares to the S&P/ASX 200 Accumulation Index, which gained 21.8% over the same period. I'd point out that the index return does not take into account any costs, and furthermore, as I've mentioned, the index's constituent companies do not pay a consistent or fully franked dividend. As many of you will be aware, Argo's share price has been trading at a discount relative to its NTA for several months. In our view, this is a cyclical trend as reflected in the data over many decades. We believe a key factor driving the current discount is the increased relative appeal of cash investments due to higher interest rates. As Australia's official cash rate rises, stocks providing stable, consistent dividends become relatively less attractive. Conversely, as interest rates fall, investors who are seeking a consistent income favour so-called yield stocks. This dynamic was especially pronounced during the global COVID pandemic, when the RBA slashed interest rates, reaching a low of just 0.1% in October 2020. In that ultra-low interest rate environment, the returns on cash investments, such as term deposits, were negligible. This drove investors to investments offering stable income and reliable income, such as Argo. During this time, our shareholder numbers surged and our share price traded at a consistent premium to NTA. The month-end share price premium reached a high of 10.9% in January 2022. As we all know, from May 2022, the RBA began raising the cash rate aggressively to stave off inflation. With official interest rates now at 4.35%, returns on cash investments are more competitive compared to Argo's fully franked dividend yield. We believe this has put pressure on our share price, particularly as investors reallocate some of their investments to cash. When Australia's rate-cutting cycle begins, resulting in lower returns from cash, Argo's ability to maintain and grow its fully franked dividend will become increasingly attractive to investors. We believe this is likely to support Argo's share price relative to its NTA. History shows us that over the long term, our share price will, on average, trade close to its NTA. In fact, over the past 30 years, Argo's share price has traded at an average of just 0.3% below its NTA. Earlier this year, we announced that our long-serving Chief Financial Officer, Andrew Hill, would be retiring. At the end of August, we farewelled Andrew after more than 30 years at Argo. This is a remarkable accomplishment. I'd like to take this opportunity to thank him for his dedicated service to the company, and as well as his diligence and expertise, which greatly benefited Argo and its shareholders through various market cycles, various events and mergers and acquisitions. On behalf of Argo, I wish Andrew all the very best in his retirement. Stephen Mortimer. Steve, you might just stand up and introduce yourself. Stephen Mortimer was subsequently appointed CFO for the company, having been promoted from the position of finance officer. Stephen joined the company in 2012 and worked closely with the Chief Financial Officer in Adelaide office throughout the period. He's a certified practicing accountant and a graduate of the Institute of Company Directors. And I'm pleased to formally introduce Stephen to you today. Let me now turn to the outlook. Australia's economy continues to be shaped largely by macroeconomic influences and including persistent inflation. As I referenced earlier, the RBA has attempted to bring down inflation and back within its target range of 2 to 3% through rapid rises in interest rates. The RBA is now navigating a narrow path between keeping rates higher to tame inflation and being too aggressive and sending the Australian economy into recession. Most developed economies are treading a similar path, and many other central banks have started to lower interest rates already, including in the United States. However, inflation seems to be a little stubborn in Australia, and the RBA is indicating that it's not likely to lower rates until 2025. In the face of all this, the Australian economy remains resilient with low unemployment, continued public and private investment, and exports supporting our national income. although there are a number of risks to the outlook, and I'd like to just step through those now. Geopolitical tensions and conflicts represent a higher risk to the world economy at this time than at this time last year. No matter who wins the United States federal election next month, I personally am concerned that the US will become more economically nationalistic, detracting from the benefits of globalisation for the world economy. China, Australia's largest trading partner, and I note largest trading partner to something like 120 countries in the world, China has a very sluggish economy, despite some recent stimulus by Chinese authorities. And at home, many Australian consumers are under financial pressure from higher interest rates and a growing cost of living for everyday expenses. And as a result, consumer confidence in particular and spending remains subdued. Against today's dynamic financial, geopolitical and economic backdrop, I'd like to remind our shareholders that since 1946, Argo has navigated through various market cycles, wars and global events, including the Cuban Missile Crisis, the oil price shocks of the 1970s, the 1987 market crash, the dot-com boom and bust, the collapse of Lehman Brothers and the ensuing global financial crisis, and the more recent coronavirus pandemic. Over nearly 8 decades since Argo was founded, the company's overriding objective has been to deliver long-term shareholder returns by providing a reliable, fully franked dividend income and capital growth. This remains our focus by continuing to apply a conservative long-term investment approach within a low-cost business model. I would like to conclude by thanking our Managing Director, Jason Beddoe, and the Argo team, many of whom are here today, for their hard work and continued dedication to the company and their absolute pursuit for the benefit of shareholders. I'd also like to thank my fellow board members for their ongoing and valuable contributions. I've greatly appreciated it. And importantly, on behalf of the board, I want to thank you, our loyal shareholders, and to any new shareholders of Argo who are here, welcome to Argo.